Hi students, welcome to the video on Jaiib and Dbf, that is Diploma in Banking and Finance. The chapter is Accounting and Financial Management at your fingertips. So there will be 100 questions, each question carry 1 mark of 100 marks. For any negative answer, 1/4, that is for each 4 wrong answer, 1 mark will be deducted. So in the first video we have discussed accounting principles and procedure in theory. We have covered all the theory and some additional theory we will cover now. Then we will discuss MCQ series on Module A. So, glimpse of the topic. In this topic, we will cover meaning and scope of accounting, basis of accounting, system of accounting, users of accounting information, classification of accounts, accounting concept, conventions, goods and service tax, that is GST, then accounting process. So, all of you know, accounting is the art of recording, classifying, summarizing and interpreting the financial transactions in a meaningful manner and communicating to the various users of the business or the company. Users may be internal users, external users. Internal users are board of directors, employees and all departmental heads, executives, managers, etc. Then external users are those who have invested in that company, that is investors. Then the government or financial institutions, they are the external user of knowing the financial statements of the company. So, in the previous video, we have already discussed account is of 2 types. One is personal account, second is impersonal account. Personal account relates to person. Personal account is subdivided under 3 areas. One is natural personal account, second artificial personal account, third representative personal account. Natural person account relates to nature, that means created by nature, human beings. Ram's account, Hari's account, Gopal's account, X capital account, Y's loan account, these are all natural personal account. Then artificial person means created by law. They are created by formed by, created by law, like your partnership or joint stock company, it may be public company, private company, etc. Then representing personal includes all accrued expenses, prepaid expenses and income, accrued income or income received in advance. Then real account, it will impersonal, means not related to person, it is subject to 2 ways. One is real account and is nominal account. In case of real account, it relates to all assets, and nominal account, it includes all expenses, losses, gains and income. So, golden rule of personal account, you know, debit the receiver, credit the giver. Golden rule of real account, debit what comes in, credit what goes out. And golden rule of nominal account, debit all expenses, losses, credit all gains and income. Then there are 2 bases of accounting, mainly cash basis and accrual basis. Cash basis I already told you, only they will make a record only when there will be receipt of cash and payment of cash. Otherwise they will not record. That is cash basis. Under accrual basis, whenever any expense income due for the entire accounting period. Accounting period may be financial year or calendar year. In the most of the units business concern now, they are applying the financial year. Financial means it begins on 1st April of one year, ends on 31st March of next year. If it is calendar year, then it is 1st January of that year, ends on 31st December of that year. Then under accrual basis, all adjustment will be done. Suppose rent is given in advance for 2 months, but 14 months rent is given by the business. But business had to show only 12 months rent are the expenses, but relating to that particular period or year. Then 2 months expenses, whatever advance paid 2 months, it will be subtracted from that expenses. As a result, correct profit loss can be ascertained. Then that 2 months rent prepaid, it will be taken to asset side, that is in the balance sheet asset side. That means it will adjusted in the next year. Similarly, any accrued expenses means liability. Suppose the company has paid the salary for 11 months to the employees. 1 month's salary company has not paid. Even though company has not paid, it is to be added to the salary of the employees. That is 11 salary, suppose 11 lakh, add 1 month salary accrued for outstanding, it is 1 lakh, so 12 lakh will be shown under profit loss debit side to salary to employees. Then that 1 lakh, it is a liability, it will be taken to the liability side under current liability. So then accounts, classification account already told, the accounting concept convention very depth we have discussed in the video number 1. Then regarding GST we will discuss now. GST, you know, goods and service tax, it is implemented from 1st July 2014, then 1st July 2017. So the motto of GST, all indirect taxes are submerged and one tax is implemented by the government, that is known as GST, goods service tax, and excluding some indirect taxes, all the indirect taxes are merged with the GST. So the purpose of GST is one nation, one tax. And GST is of 2 types. It may be intrastate GST or interstate GST. When both supplier of goods and service and receiver or recipient of goods and service belong to same state, that is the supplier, seller and buyer belong to same state, it is known as intrastate GST. Under intrastate GST, whatever GST paid by the purchaser to the supplier, supplier has to pay 50-50 to the 50-50 ratio to the government. That is, if it is intrastate, 50% will go to CGST, that is central goods service tax, and 50% will be given to the state GST. If it is interstate GST, that means the supplier belongs to one state and the receiver or recipient belongs to another state, then it is known as interstate GST. In this case, IGST will be paid. That IGST 100% will be taken to by the central government. Then under GST, normal GST payment procedure is like this. Then supplier of goods and service, it will send goods and service to the receiver of goods and service. After receiving the goods and service, the receiver will make payment for goods received and service rendered by the supplier. Then he will also pay GST. Along with the price, he will pay GST to the supplier, because the supplier is a registered GST dealer. Regarding GST, there may be 5% GST, 12%, then 18%, 28%, 4 category of GST are there. Whatever may be the case, in case of intra GST, if it is 5%, 2.5% will be given to the central CGST, another 2.5% to HGST. If it is 12%, 6%, 6%. If it is 18%, 9%, 9%. If it is 28%, 14% will be paid to CGST, another 14% to HGST. If it is IGST or interstate transaction, then entire will go to central government. Sometimes here GST payment in case of reverse charge. What is reverse charge? In case of reverse charge, the supplier of goods and services is non-registered of the GST. That means it is not eligible. There is some limit for goods. It is annual turnover. If it is 40 lakh and above, and for service it is 20 lakh and above. Some particular state and union territory, it is 20 lakh for goods and limit is 10 lakh for service. If they exceed that, then they are bound to register their unit. But in case the non-registered supplier of goods and service will send goods and service, will send goods or render service to the registered customer recipient. That means the supplier is not the registered GST holder, but the receiver is the registered GST holder. In this case, the supplier will send goods or render service to the receiver of goods and service. As a result, the receiver of goods service will pay price for goods and goods received and service rendered or service received. That is, but he will not pay GST to the supplier. Instead, directly he will pay the GST to the government. Then another is input tax credit. That means when the receiver of goods and service is paying GST at the time of purchase of goods service from supplier, that is known as input GST, and the receiver again sell the goods and render service to his customer, then he is receiving the GST, that is known as output GST. That is GST collected from the customer by him. Here GST paid is input GST, GST collected is output GST, and he has an option to adjust his input GST out of his output GST collected. That is known as input tax credit. GST Act allows to adjust tax paid at the time of purchase with the amount of tax collected, and the balance of tax liability will be paid to the government. So, what is the input credit mechanism order? In case of input credit mechanism, if it is input, if the recipient has paid inputs CGST, that input CGST will be set up adjusted first out of or against its output IGST at the time of selling goods to the interstate, means out of state customer. He belongs to, suppose, Bhubaneswar, he will sell customer to of Andhra Pradesh. Then only that output IGST, his input CGST will be adjusted from output IGST. That means first he will, after receiving the output IGST, he will try to adjust his input CGST. If output IGST is not sufficient, then he will adjust the output CGST. Output CGST means within state he is selling, then he is receiving the CGST, that means output CGST. Then if after adjustment something is left, carry forward, the balance input CGST account as asset, it will be asset, it can be adjusted in next year, or pay if the balance outstanding is more. Then input AGST. Here input AGST, again it can be set up against only first output AGST, second output AGST. Then balance will be carried forward as asset if it is excess, then or pay if balance is outstanding in output AGST. Then input IGST will set up against output IGST first, then if it is not sufficient, output CGST, then if it is not sufficient, it will adjust from output IGST. In case of input IGST, setup procedure can be applied to all, that is output CGST, output IGST first, then CGST, then output SGST. Output SGST. So this is all about the GST. Then the accounting process. While accounting process, these are the procedure. First is source document. Already told you, there must be certain proof regarding a particular transaction, that is known as source document. It may be invoice, bill, receipt, credit memo, deposit receipt. That is otherwise known as evidence of that voucher. Then after getting the evidence, purchasing the goods, it will be recorded in the books of original entry or prime entry, that is known as journal. From the journal, transactions are posted to various respective accounts, that is known as ledger. That account is in T form, and for particular type of account, all transactions relating to that account will be posted on the debit side and credit side of the account. Then it will be balance. Balance means if debit side is heavier than the credit side, it is known as debit balance. On the credit side, it will be written by balance carried down and the amount is adjusted. And in the next year, it will be taken to debit side as to balance brought down. That is known as opening entry. Here closing entry, then opening entry. Like this, all the accounts are balanced. Then the balance amount will be carried forward to the trial balance. Trial balance serves as a summary of what is contained in the ledger. So this is trial balance. In the trial balance, that is, it is prepared as on a particular date. Suppose at the end of the year it is prepared, then it is written particulars, then debit balance, credit balance. Suppose cash in hand is 2 lakh, it is written debit balance suppose. Then cash at bank, suppose 3 lakh, it is written here 3 lakh. Then plant and machinery 5 lakh, it is written here plant and machinery 5 lakh. Then other current asset, cash in other current asset, that is inventory, bills receivable. Suppose total is suppose 2 lakh, it is 12 lakh. Then capital, suppose 10 lakh, and another suppose sundry creditors, here suppose 2 lakh, then it will be total 12 lakh will be balance, that is known as trial balance. In case of journal, now in any business, transactions are numerous. When transactions are numerous, it is not beneficial to record all the transactions in the journal, then to post it in the ledger. For that, subsidiary books will be prepared. Subsidiary books. That is subdivision of journal. It is of 8 types. One is cash book. All transactions relating to cash in bank, cash in hand, cash at bank, discount will be posted in the cash book. Cash book is having suppose single column, double column and triple column. In case of triple column, debit side of cash column shows receipt of cash. Debit side of bank column shows cash deposited or check deposited in the bank. Debit side of discount column of cash shows discount allowed. Then that is cash discount allowed, because already you know trade discount is directly deducted from the invoice. For that no journal entry is required. whatever is written, it is regarding cash discount, so it is written in the cash book. Then the credit side of cash column shows cash withdrawn or cash payments. Then credit side of bank column of cash book shows cash withdrawn from bank or check issued to various customers who have withdrawn money from the bank. Then discount received, that is cash discount received. This is all about the cash book. Then purchase book. All credit purchase of goods are written in the purchase book. Then sales book. All credit sales of goods will be written in the sales book. Then purchase return. Whenever we are purchasing goods from the supplier, we have every right to return the goods. If the goods are not according to our specification, then it is known as purchase return or return outward. Then sales return. Similarly, our customer have every right to return to us, that is known as sales return or return inward. Then bills receivable book. In case of bills receivable, the seller may not depend on the buyer. That means the seller, there is no guarantee that the buyer will make the payment on credit sale. In that case, the drawer will draw a bill. He will write, suppose he has sold goods worth 10,000, he will write pay Mr. X, his name, that is drawer or his order, rupees, suppose it is 10,000 rupees, 10,000 after 2 months and value received, then the drawer will receive the bill. For him it is bills receivable. He reads the content of the bill. If he agrees, you write accepted. Within 2 parallel, you write accepted. Then bill is accepted by him. For him it is bills payable. You send the bill to the drawer or seller. For seller it is bills receivable. For buyer it is bills payable. So bills receivable and bills payable. Then what is the purpose of this? The drawer has 3 options. First, he may keep the bill till the date of maturity. On the maturity date, he will send the bill to the drawer to receive the payment. Then, second, if he is in need of money, he will go to the bank, discount the bill at the bank. Bank will keep some percentage of charges, interest for unexpired period of the bill. Then, on the due date, bank will collect the amount from the drawer. Third case, if he has the third party, that is supplier Z, he will endorse the bill in favor of Z. On the due date, Z will collect the bill from the drawer. This is all about bills receivable, bill payable. Any transaction which will not find its place, it is recorded in the journal proper. Journal proper, it is just like book. Journal proper. Suppose machinery purchase. Machinery purchase will not find its place in this case, then it will be recorded in the journal proper. Depreciation machinery, it will be recorded in the journal proper. This is all about. Then I already told you, then jump from journal, transactions are posted to ledger. Ledger it is balance, then trial balance is prepared. All the 2 sides, debit balance, total, debit total balance, credit total balance tallied, then trial balance is correct. Then from the trial balance, financial statements are prepared. That financial statement may be first trading account, profit loss account, then from profit loss, this is known as income statement. From profit loss, the net profit and net loss can be ascertained. Then balance sheet, as a mirror reflect the face of a person, balance sheet reflect the financial position of the concern, showing assets on one side and liability on the other. This is known as positional statement. Then another cash flow will be done. Cash flow statement already told you. Then there is reconciliation of cash and cash equivalent at the beginning with the end. That is, in between there is inflow of cash and outflow of cash. It may be from operating activity, investing activity and financing activity. Then last one is statement of changes in equity. So statement of changes equity means it is the reconciliation between the opening balance of equity of a company and closing balance of shareholders' equity. It summarizes the transactions related to shareholders' equity over an accounting period. Within a year, what is the change in the equity that will be shown in the statement. So this is all about the theory. Then we will solve all the multiple choice. So it is given first, accounting with the dash of monetary transactions, recording, verification, tallying and all of them. So all of them is correct. Accounting is concerned with transaction involving given A, money, B, no money, say 3, movement of human, none. So money, because all of you know only monetary transactions are recorded in the accounting. Whatever may be the importance of case, if it cannot be measured into money, it will not find its place in accounting. Just like suppose quality, there arises quarrel among the different departmental heads of an organization. Definitely it will hamper the progress or continuity of the business and profitability of the business. As it cannot be measured in terms of money, it will not find its place in accounting. Then third, accounting transaction relate to dash, income, expenses, asset, liability, inventory. All of them is the correct answer. Form used to record accounting transaction contain T. T form I already told. This is in T form. So date, particulars, ledger folio, debit amount. This is debit side 4 column. Credit side also 4 column. So this is date, particular, ledger folio, amount. So 8 columns. So it is given form you to record. It is in T form. Ledger is in T form. Ledger in T form. So debit side is having 4 column, credit side is having 4 column. It is given form you to record accounting transaction contain dash column. It is 8 column. First 4 columns of account sheet are used for recording, it is debit. Second 5 to 8th column of that account sheet are used for recording credit. So the method of recording debit and credit side separately by a line nicknamed dash accounting. It is in T form. It is written TUBW. So T is the correct answer. Accounting system which consider assets, liability, revenue, expenses is called dash method of accounting. Actually, it is given British, American, Indian, none of them. So it is American method of accounting. Accounting system which consider assets, liability, revenue, expenses is called American method of accounting. So accounting system which consider personal account, real account, nominal account is called dash method of accounting. It is British method of accounting. So asset, liability, revenue, expenses, American method of accounting. Then personal account, real account, nominal account, it belongs to British method of accounting. Recording a debit and credit of individual bank accounts, other business sources is called dash. It is personal account. All transactions related to person are recorded here. So recording a debit and credit related to movable asset, immovable asset, inventory, stock needed for production is called dash account. It is so asset, movable asset, immovable asset, it is real account. Then recording of debit and credit related to income, expenses, inflow of money, outflow of money is called nominal account. Already we discussed. Dash concept of accounting consider the business and owner are different entity. It is business entity concept. For that again and again you have to view video 1. Then dash concept in accounting consider that only transaction involving money should be recorded. It is money measurement concept. Then 15. Dash concept in accounting consider that the business is a perpetual entity. Going concern concept consider that business will last for a longer period of time. Dash concept in accounting, consider that each debit has a corresponding credit. It is dual aspect concept. Every transaction is having double side effect. If the one transaction affects the debit side of one account, simultaneously will affect the credit side of another account. That is known as dual aspect concept. Dash concept in accounting consider that actual cost of transaction should be recorded, not the market value of transaction. It is cost or historical concept, historical costing. That in this case, suppose we are purchasing a machinery by paying 10 lakh, then machinery cost is 10 lakh, transportation cost suppose it is 20,000, we have retained, installation charges suppose 30,000, so the cost of the machine is 10 lakh 50,000. That means at the time of purchasing, this is known as original cost or historical cost. In the original cost, all the expenses are added in the first year. At the time of purchase of machine, any addition, any expenses incurred, that is capitalized in nature. So depreciation will charge from the end of first year. From first year, depreciation charge. Suppose depreciation 10 lakh 50,000, depreciation suppose 10%, that is 1 lakh 5,000. Depreciation, then book value will be 9 lakh 45,000. This is book value. Second year, book value or reducing value will be reduced by depreciation. So first year, it is always on cost. So 19. Dash concept in accounting consider that an account should be closed on a periodic basis and be opened. That is known as accounting period. I already discussed in this video. One is your financial, another calendar year. The dash concept in accounting consider that revenue is recorded on the date of transaction itself, but expenditure is incurred recorded only on the date of inflow of money, not on the date of transaction like encashing a check. It is under accrual basis. Accrual basis means any cash received at the time of monetary receipt, date of receipt of transaction. Revenue is means the date of receipt is known as revenue. Date of receipt is the date of received revenue. That is revenue date. But in case of expenditure, it is accrue. On due date, it may be paid or may not be paid. That is accrual date is considered. So it is under accrual basis of accounting. Then 21. Dash concept in accounting consider that each transaction should be supported by evidence. This is objective evidence concept. Dash account debit the receiver credit giver. This is the formula for personal account. Dash account debit the income, debit the incoming asset, credit the outgoing asset. For real account, debit what comes in. Debit the incoming asset, credit the outgoing asset, or debit what comes in, credit what goes out. Dash account debit expense, credit the income. That is nominal account tells debit all expenses, losses, credit all gains and income. Dash denote increase in money. Increase in money means it is credit. Increase in money means it is credit. Dash consider incoming money should be instantly available and reduction of cash to occur only on the date of accrual, outflow of money. It is accrual basis. Dash denote movable, immovable property and inventory. It is asset. Dash consider that each debit has a corresponding credit. It is double entry system of accounting or double entry accounting. Evidence proof of a transaction is called voucher. Dash is a formal recording of financial transaction. It is voucher. A voucher has a dash sides. It is having two sides. So one is debit side, another credit side. The left side of a voucher is meant for debit entries. Right side of a voucher is meant for credit entry. Dash voucher changes inventory position. That is inventory voucher. 35 voucher. Then voucher changes monetary position. When voucher changes monetary position, it is accounting. Dash voucher transfer money from one deposit or loan account to another, it is contract. In bank, generally the previous people are following contra voucher, that is one debit, another credit. On the one carbon will be put in between, then narration is written, so debit is kept and first one is debit and second one is credit. So recording of transaction and event as and when they occur and classifying them into suitable accounting heads is called the subject matter of bookkeeping. Bookkeeping is merely concerned with recording of financial data relating to dash, means business, in significant or orderly manner. Basic function of accounting is to interpret the financial data is the correct answer. There are two systems of accounting, all of you know. One is cash basis, another accrual basis. Another hybrid basis is third one is there. So the system of recording transaction based on dual aspect concept is called double entry system. As per the dual aspect concept, asset is equal to liabilities plus capital. This is also accounting equation or dual aspect concept. Asset of a firm is 10 lakh, capital of the proprietor 4 lakh, so liability is asset minus capital, that is 6 lakh. Which of the following will be goods for a business run by furniture merchant? You remember, the nature of trading depends on whether it will be related to the trading account or it will be treated asset. Suppose a shopkeeper, an electronic shop. An electronic shop is purchasing furniture, table, chair, electronic shop, table, chair, or arranged to allow the customer to take rest or to have dealing, business dealing. That is, when an electronic shop is purchasing that is chairs and tools, chairs and tables, that will be taken under asset. That is asset. If but it is given furniture merchant, for furniture merchant, purchase of chair and table is trading account, it is business. Furniture merchant is business is to purchase or manufacture table and chair, that is furniture to sell in the market, it is under trading account, not asset. Which of the following is not a business transaction? Rent paid to landlord 5,000, yes, it is business transaction. Goods purchased from J 20,000, business transaction. Placed an order to Chandra and Company for purchasing goods for 38,000. Yes, there is only placement of order. No advance has been given. So there is no transaction. This is the correct answer. Received interest from bank, it is business transaction. The 46. Which of the following item is not financial nature? Purchase of a car on credit, yes, it is financial nature. Dismissing an employee from job, no, it is quality. It is not measured in terms of money. It cannot find its place in accounting. So it is not financial nature. It is correct. Then given withdrawal of cash by proprietor for personal use, yes, it is financial transaction. Purchase of building for cash, financial. Total asset of a trader 42,50,000. Outside liability 7,50,000. So owner's equity is, that is asset minus liability, that is 25 lakh, correct answer. Maintaining a systematic record of all business transactions is termed as classification of records. Classification of record. Then 49. Accounting in the modern times is treated as dash. An art of recording, classifying, summarizing business transactions in monetary units past. It is the language of business, the source of business information. All three are correct. So all of the above. So external user of accounting information involve board of director. No, is board of director. I already told it. He is the internal user. Purchase manager, internal user. Sales manager, internal user. But tax authority is correct answer. Tax authority is the external user. Which of the following is not dependent on accounting? Management decision, yes, it is purely depends on the accounting. Financial accounting, yes. Cost accounting, all three. But bookkeeping is not dependent on accounting because bookkeeping is the first. That means the duty of bookkeeper to record the business transaction, recording, classifying, summarizing is the duty. Up to preparation of trial balance is the duty of the bookkeeper. The duty of accountant starts where the duty of bookkeeper ends. That means the accountant will prepare trading account, profit loss account, balance sheet, cash flow statement, fund flow statement, that is changes in the equity, all are the duty of financial accountant, that is accountant. The basic rule of bookkeeping, debit, receipt, credit is applicable to it is personal account. So find out the profit from the following. It is given capital at the beginning of the year. Just you remember, it is given like this. So before discussing this problem, the maximum adjustment I am telling you regarding the capital. Maximum adjustment regarding capital in case of any company or what are that. So capital at the beginning of the year. Capital at the beginning of the year plus net profit plus interest on capital plus additional capital. This is the maximum adjustment minus drawing, where the proprietor would draw for his personal use, known as drawing. It will be deducted from capital. Then interest on that, that is interest on drawing. Then net loss if any. This is the maximum. In this problem, what is given? Capital at the beginning given 4 lakh. It is given 4 lakh. Then drawing during the year given 50,000. It is given 50,000. Then capital at the end of the year is given. It is capital at the end of the year. Capital at the end of the year. It is given 4,50,000. It is given. Then capital introduced during the year is given 25,000. That is additional capital. Capital introduced. You remember what I told? First 4 lakh, add additional capital 28,000. So total comes to 4 lakh. 4,25,000. Then deduct drawing. So it is 3,75,000. So 4,50,000 is the capital at the end. So definitely net profit is balancing figure. It is 75,000. Net profit. This is the balancing figure. Just you do 4 lakh here. It is capital at the beginning. Then net profit 75,000. Additional 28,000. It is coming 5 lakh. So less drawing 50,000. 5 lakh less. It is 5 lakh. Less drawing 50,000. So capital at the end is correct, 4,50,000. So correct answer is net profit is 75,000. Then classify following accounts into personal, real, nominal. You tell drawing account. It is capital and drawing both are personal account. Bank account, personal account. Cash account, real account. It is asset, real account. Discount account, nominal account. Patent account, real account, because it is intangible asset, fixed assets. That is non-tangible fixed asset. Arihant Industry Limited is personal account. Goodwill, that is real account. Salaries, nominal account. Bad debt, nominal account. Capital account, already told. Capital drawing, personal account. Machinery account, real account. Salary outstanding, it is personal account. Representative personal account, I told you. Salary outstanding expense on or prepaid insurance. Stock, closing stock, it is real account, asset. Bank, it is personal account. Overdraft, it is liability, it is also personal account. Then purchases, purchases is nominal account. Purchase, sales, nominal account. Bills receivable, real account. reserve for discount on creditor, it will be deducted from sundry creditor. Reserve for discount creditor, it is also, that is expense, nominal account. Then 56. According to going concern concept, business entity is assumed to have a long life. Correct. Contingent liability is shown in the balance sheet at footnote. Contingent liability is shown in the footnote. First balance sheet will prepare. Below the balance sheet, contingent liability will be shown. So it is due to convention of disclosure. Revenue is considered to be earned as and when, that is sale is. Revenue is only considered when sale is effected. Then accounting does not record non-financial transaction according to money measurement concept. According to which of the following concept, even the owner of the business who provides capital treated as creditor of the business, it is according to business entity concept. According to business entity concept, business is treated separate from its owner. So when the proprietor or the owner is withdrawing, giving capital to the business, it is his liability, it is liability of the business, that is capital. From the capital, if he is withdrawing anything, that is cash, goods, then drawing, it is deducted from capital. So it is business entity concept. Means under 60, according to which of the following concept, even the owner of the business who provide capital treated a creditor of the business, it is according to entity concept. Appending notes to financial statement as per dash convention. So as per disclosure convention, the company or corporate has to give appending notes regarding the two financial transaction statements of his business. Then according to accounting of a small calculator is an expenses, not an asset, is due to dash materiality convention. Materiality convention means suppose one calculator is purchased. When a business is purchasing a calculator, it is showing as an expense. But the same business is purchasing a laptop. Purchasing a laptop is showing under capital expenditure. That is asset, capital expenditure. Here this is revenue expenditure. Calculator is treated as a revenue expenditure, as a laptop treated as capital expenditure. It is due to materiality concept in accounting. Following the written down value method of depreciation of particular asset hereafter because of dash convention, that is consistency. Consistency method tells that whatever procedure method followed, it should be followed year after year. If every accounting year, that is consistency. Suppose depreciation. All of you know what is depreciation? Depreciation means decrease in the value of assets due to wear and tear, means use. Then effluxion of time means passage of time, and obsolescence means when assets become outdated, that is obsolescence. So depreciation it may be charged on straight line method. Straight line every year the same amount will be treated as depreciation. Straight line. Suppose machinery worth is 10 lakh. It gives benefit for 5 years. Every year 2 lakh will be charged as depreciation. At the end of 5th year, the amount, the value of assets is zero, nil. But under the reducing balance method, every year 20% will charge. Suppose 10 lakh was at the first year, then 2 lakh 20% is charged. At the end of first year it is 8 lakh. Then in the second year 20% on 8 lakh, that is 1 lakh 60. So the value at the beginning of third year is 4 lakh 60, like this. And 4 lakh 60, 20% will charge. Like this it will continue. But the value will never be zero. The question may ask, under which method of depreciation the value of machinery will never be zero? That is under reducing balance method of depreciation or written down value method. It is otherwise known as written down value method. It is due to consistency, that is the convention. So valuation stock is done at lower of cost or market price whichever low because of conservative principle. That is conservative. Accounting follows the conservative principle. If there is possibility of any profit, unless and until profit happens, it will not be taken into account. If there is any possibility of loss, that is provision against bad debt, then it will be taken into account. This is due to following of conservative principle. Making provision for doubtful liabilities as per dash convention conservative. Contained liability shown in the balance sheet arise due to accounting convention of disclosure. That is disclosure. Accounting principles are generally based on dash practicability, subjectivity, convenience in recording, objectivity. It is on practicability. Accounting principles are generally based on practicability. According to money measurement concept, the following will be recorded in the books of the business. Health of director, no. It cannot be measured in terms of money. Quality of company goods, no. Utility of manager, no. So value of plant and machinery can be measured in terms of money. It is correct answer. So the convention of conservatism when applied to the balance sheet results in understatement of asset. When we are following the conservative principle, then definitely we are showing the value of asset in first. Suppose the at original cost, then every year depreciation. So it is based on, it is understatement of asset. Accounting concept include those assumptions upon which the science of dash is based. Accounting is based. A firm follows the straight line method of depreciation, depreciating fixed asset year after year due to consistency. A change in accounting policy is justified to comply with law. Yes. If the law needed, then there must be change in the accounting policy. Second, to comply with accounting standard. Yes. To ensure better presentation of financial statement part. All the above are correct. Which of the following is fundamental accounting assumption? Full disclosure, materiality, going concern, accounting period. So answer is going concern concept. Revenue is generally recognized at the point of sale. It is due to realization concept. Assumption that a business enterprise will not be sold or liquidated in the near future due to going concern concept. Companies must prepare financial statement at least yearly due to the periodic concept. The dash principle requires the same accounting method should be used from one accounting period to another. It is principle of consistency. Expenses not yet paid but belong to the same accounting period are recorded as per accrual concept of accounting. Classification asset as current asset, fixed asset is as per going concern concept. Already in the previous video, in the first video, we have discussed the relevance and importance of going concern concept. In the going concern concept, it considers distinction between capital expenditure and revenue expenditure. Capital expenditure versus revenue expenditure. Then current asset versus non-current asset. Non-current asset is otherwise known as fixed asset. Non-current or fixed assets. So this is due to going concern concept is the correct answer. General reserve is created on the basis of convention of conservatism. See, in case of company prepares trading account, profit loss account, and also another profit and loss appropriation account, then balance sheet. So already told you the balance sheet of a company is now prepared in vertical form. So first trading account is prepared. From trading, gross profit, gross loss will be ascertained. Gross profit or gross loss. Then profit and loss account will be prepared. Then net profit after tax. From net profit, tax will be deducted. So net profit after tax is arrived. Net profit after tax. Then it will be transferred to profit and loss appropriation account. Appropriation account by net profit. Transfer from profit and less profit after tax. Net profit after tax. Then what the company does? company transfers some portion to its general reserve. To transfer to general reserve. Then other provision is there. To provision. Then dividend to preference shareholder. Then finally dividend to equity shareholder. Here first to preference shareholder, then equity shareholder. Then it will prepare balance sheet. So general reserve is created on the basis of convention of conservatism. What will be the current classification of goodwill and bill discount not mature? One is goodwill. Goodwill is real account, non-tangible asset. Goodwill, patents, copyright, trademark, non-tangible assets. So goodwill is real, it is real account. Then bill discounted, not matured. That I told you. Bills discounted, not matured. That means the bill is a discounted bank. For bank it is asset. Bank is keeping the bill till the date of maturity. So it is not mature. So if the party will not make the payment, then the bill will not be made. So it is known as contingent liability. It is written on the footnote of balance sheet. Contingent liability. Similarly, bills sent for collection not realized. That is also contingent liability. Although contingent liability are shown in the footnote of balance sheet. Which of the following is not a business transaction? XYZ availed a discount for prompt payment of to supplier. Yes. XYZ paid 1 lakh for buying furniture for shop. Yes. XYZ is negotiating with the customer regarding supplier goods. No. They are negotiating. It is not a business transaction. So none. Yes. Then gross book value of fixed asset is its dash. It is historical cost. Already told, it is based on historical cost. A credit entry in a real account means decrease in the value of asset. Before that, I am telling you one modern rule. Besides the golden rule of debit and credit regarding real account, personal account, nominal account, one modern rule is there. Modern method. According to modern rule, one is there are 5 elements, 5 basic elements of accounting. One is assets, expenses, that is debit balance. Then liability, capital or equity, then revenue. You remember the formula. Increase in assets and expenses. Increase in assets and expenses debited. Decrease in asset and expenses credited. And reverse in the case of liability, capital, revenue. Increase in liability, capital and revenue should be debited. Capital and revenue should be debited. And decrease in liability, capital and revenue should be credited. So this is the modern concept. So a credit entry in a real account means decrease in the value of asset. Credit means decrease in the value of asset is the correct answer. Contingent liability appears in the notes and footnotes means in case of corporate account it is known as notes and account to balance sheet. Notes and account to balance sheet. Notes and account, it is compulsory. Account to balance sheet. The corporate has to prepare notes and account to balance sheet. in case of publishing the financials. Main objective of bookkeeping is to keep correct and complete record of business transaction is the answer. Life insurance premium received by an insurance company should be classified. When one insurance company is receiving the life insurance premium, so here insurance company is receiving life insurance premium. Life insurance premium. Suppose one person has insured his life on 1st October 2023. Then he has paid for 1 year, suppose 20,000 insurance premium. But he has paid for 1 year. But the life insurance premium is received for another 36 months for current year, another 6 months for next year. So this is known as earned revenue. That is liability of the life insurance company. Trial one should always tally due to the result of every debit has a corresponding credit is the correct answer. Which of the following is real account? Salary account, nominal account, Ram's account, personal account, building account is real account. Interest account is nominal account. Time gap between the payment of raw material purchase, collection of cash from sale is known as cash cycle. One is cash cycle. One is accounting cycle. Another is cash cycle. So under cash cycle, the gap between payment of raw material purchase and collection of cash. Payment of raw material purchased and collection of cash from sales. Collection of cash from sales. You see, at the time of purchase, the business will purchasing the raw material on payment of raw material for purchase. He is making payment for his raw material, but he is waiting to collect the cash from his debtor to whom he sold goods on credit basis. This cycle is known as cash cycle. But under accounting cycle is like this. Suppose on manufacturing concern, the accounting cycle is here first purchase of raw materials from creditor, suppose. Purchase of raw material from creditor, suppose. That is on credit. Then he is then making the payments, that is payment of cash or raw material. Payment of cash. Then he is converting the raw material into work in progress. Then from work in progress to finished stock. Then to finished stock. Then after getting the finished stock, he is selling in the market. Some he is selling on cash, other mostly on credit. Then that credit he is realizing after suppose 2 months. So this is known as accounting period. Suppose for purchase or material payment, suppose it takes 2 months. Then finished product suppose 3 months, it is 5 months. Then credit suppose 2 months, 7 months. So it is 7 months is the accounting cycle. So this is 90. Then 91. We will start from GST. So GST stands for Goods and Service Tax, correct. In India, GST became effective from 1st July 2017, correct. GST was introduced in Jammu and Kashmir. It is on 8th July 2017. Jammu Kashmir is separate. Jammu and Kashmir from 8/7/2000. In other state it is 1st July 2017. that is GST introduced, implemented, introduced. The incidence of tax on tax is called incidence of tax on tax. It is called tax cascading. Tax cascading. That you have to understand. What is tax cascading? Before GST, so manufacturer was manufacturing the goods. Manufacturer sold to wholesaler. Then manufacturer, the cost of goods manufactured plus GST plus it is VAT, value added tax of that, sell tax or there. So cost of goods manufactured. Then he sell it to the wholesaler. Already collected the VAT or sell tax is included. Then wholesaler is selling to the retailer. Again also he is adding the VAT. Wholesaler, that is cost of sales plus VAT or sell tax. Again the wholesaler to retailer same his sales price plus VAT. So every time the manufacturer has paid VAT for the same product, wholesaler again paid VAT, retailer again paid, then it is to the consumer. Consumer has to pay the indirect tax, that is VAT. This is known as tax cascading. But under GST, only for additional amount tax is paid. It is on value addition. Any value addition tax is paid. This is known as value addition, that is GST. Suppose here the manufacturer is manufacturing goods for, suppose it is 1 lakh, then plus suppose 12% GST, 12% GST. Then here he is getting, suppose he is selling, suppose on 1,20,000, that is wholesaler selling to retailer. So on that 20,000 only 12% GST will be taken, 20% GST. Suppose the retailer is selling to the consumer as 1,50,000, on 30,000 only he is charging GST. That avoids the tax cascading which was prevalent before GST when there is indirect tax system in the country. So the incidence of tax on tax, it is known as tax incident. Incidence, most important, of tax on tax. Tax on tax. But here in GST only tax is paid. GST is paid on any value addition. Tax is paid. Tax which are not merged into GST is here countervailing duty, excise duty, purchase tax, basic custom duty is not merged into GST. Basic custom duty, it is kept separate. It is not included under GST. That is basic customs duty. GST is a matter of jurisdiction of both center and state government. Which of the following goodwill not covered under GST? Which of the following good will not be covered under GST bill? Cooking gas, not covered. Liquor, not covered. Petrol, not covered. So answer is all of the above. Under GST law, tax rates are determined by one GST council is there. GST council, it is containing the main is finance minister, then some ministers from all the states and union territory. They are the member. I think 33 members. Highest GST slab rate is in India is 28%. So 4 slabs. One is zero tax is there. It is not essential. So generally 5, 12, 18, 28. This is 4 types. 0, 0 for some commodity, tax is not, GST is 0, not tax. Who confer power to Government of India to collect tax on intrastate supply goods? For intrastate supply goods, one CGST Act is there. CGST Act, that is intrastate supply of goods or service or both is under CGST Act. On intrastate sale of goods, GST charge is, if it is intrastate, I already told you, it is divided into two ways, 50-50, that is 50% go to CGST, central GST, another 50% will kept with the state GST. On interstate sale of goods, entire GST is charged under IGST, will be given to the central government. GST is applicable on both goods and services. GST comprises of CGST means Central Goods Service Tax, AGST, State Goods Service Tax, Union Territory GST, UT GST, then Integrated Goods Service Tax, IGST, all the above is correct. GST Council can take a decision only if there is dash, 3/4 of majority, 2/3 majority, 60% majority, then simple majority, that is 60% majority. The GST Council can take a decision only if there is 60% majority. Which tax is not subsumed in GST? That is included under GST. Stamp duty is not included. It is the property tax. That belongs to different state. It is not included under GST. Entry tax is included. Entertainment tax is included. Which of the following an intrastate supply? It is given. Supply goods located in Nagpur and place of supply goods located in Mumbai, same. Nagpur belongs to Mumbai, so both are same. That is intrastate. Then supply goods located in Kolkata, place of supply goods in Bangalore. It is which is intrastate. So Nagpur and Mumbai are different. It is interstate. Then Kolkata and Bangalore, interstate. But supply goods located in Goa, place of supply goods in Goa, it is intrastate. The chairperson of GST Council is Union Finance Minister. I already told you the GST Council consists of 33 members, which includes Union Finance Minister head, that is Nirmala Sitharaman, chairperson. Then Union Minister of State in charge of Revenue or Finance, that is 33 members from all the state and union territory. The HSN code stands for HSN code. That is in GST, while all the officers who are processing loan or collecting GST receipt, they might have known it is what is HSN. So HSN means harmonized system of nomenclature. Then input tax credit availability. Where input tax credit will be available on receipt of goods? No. On payment of tax paid by supplier to government. That is, at the time of payment of tax by a supplier to the government, he will avail the input tax credits. Registration under GST is not compulsory. To dash, casual taxable person, input service distributor, non-resident taxable person, all has to register under GST according to the eligibility of turnover. So reverse charge mechanism under GST, where supplier goods to pay tax, recipient of goods and service is liable to pay tax. It is correct. Because the supplier goods, when the supplier goods is not a registered GST dealer, then the recipient of goods, if he is a registered recipient or registered trader, then he has to pay directly GST to the government. So answer is, in case of reverse charge mechanism, GST, recipient of the goods and service is liable to pay goods and service tax instead of supplier to the government. Then, which of the following tax have been submerged in GST? Central sale tax, yes, it is submerged. Central excise duty and service tax, it is also submerged. VAT, value added tax, it is also submerged. So all the above is the correct answer. All are submerged with GST. GST is levied on supply of goods and services except alcoholic liquor for human consumption is excluded from the GST. Who shall be empowered to levy collect GST on supplies in course of interstate transaction of trade and commerce? That is central government, state government, union territory, all the above. All are empowered to collect the GST. GST is a dash based tax on consumption. It is destination based tax, means ultimately the consumer has to bear the GST, that is known as destination based tax on consumption. In India, GST came into effect from 1st July 2017. India has chosen dash model of dual GST, Canadian model of dual GST. Indian GST model has rates. There are 4 rates I told, 5, 12, 18, 28. GSTN stands for Goods Service Tax Network. Then GSTN, Goods and Service Tax Network. Power to declare certain activity or transportation as neither supply goods nor service, it is vested in Schedule 3. This is under Schedule 3. Under Schedule 3, there is power to declare certain activity or transaction neither supply goods nor service. Schedule 1, it outlines a specific activity considered supply without consideration if there is agent principal transaction. Then 3, certain activity classified as goods and service both, means brick, suppose manufacturer or contractor is purchasing bricks, cement, land, sand for construction. Then simultaneously also he is doing service. This is for charges for goods, and for service, that is construction charge. So this includes both goods and service. So it is given. So it is Schedule 3 according to Schedule 2. This is Schedule 2. Then we will discuss the basic accounting equation is equity is equal to asset minus liability, means already asset is equal to liability plus equity or capital. It is the basic accounting equation. The accounting cycle does not include recording, classifying, decision making, all are there, interpreting is not there. Good of the value of 1,500 taken by proprietor for personal use should be debited. When the proprietor is withdrawing either cash or goods for his personal use, it will be debited to drawing account. Drawing account is debit form of capital. When the proprietor is giving cash to the business, it is under capital. When he is withdrawing, it is drawing. Goods destroyed fire should be credited to dash purchase account. When goods destroyed fire, then read goods destroyed fire account debited to purchase account. So purchase is the correct answer. Credit balance of bank account indicates. Generally bank account should be debit balance. Debit balance means it is asset of the businessman. But when there is overdraft facility, when the banker is allowing to withdraw more than its deposited amount, it is showing credit balance. That is bank overdraft. Which of the following account invariably have a debit balance? Bank account, no. It may be debit balance, credit balance. Amount payable account, credit balance. Loan account, credit balance. This is maybe debit or credit balance. If the loan is there, it is debit balance. If surplus has been deposited by the businessman current account holder, it is credit balance. Then account receivable is debit balance, correct answer. Which of the following account invalid have a credit balance? Discount allowed cash account, accounts payable. Accounts payable is credit balance, but discount allowed cash account is debit balance. Which of the following account is only credit balance? Only credit balance. Accounts payable, yes. Salary outstanding, it is liability. Accounts payable, liability. Reserve fund, liability, all are credit balance. Yes, all of the above. Which of the following account may have a debit or credit balance? I told you loan. If the borrower or the businessman has availed the loan and amount is lying against him, it is debit balance. If he has deposited more than the loan amount, then it is his credit balance. This happens generally in case of current account holder who has availed the CC and the current account has been converted to CC. If the businessman deposited more than the loan amount, then it shows credit balance. The dash record daily transactions of business in the order in which they occur. Journal is the books of original entry, prime entry, and transactions are recorded in the journal as and when it occurs, means in a chronological order according to order of their occurrence. Debit reserve, credit giver is the rule of personal account. Various debit and credit balance differ in account taken down in a statement which is known as trial balance. So trial balance serves as a summary of what is contained in the ledger. As a rule, the closing balance in the account ends with suffix. If it is closing balance, we write carried down. If it is opening balance, we write brought down. So CDBD is the correct answer. Identify the correct golden rule of journal. Income and gain, debit. No, it is credit. Increase in equity, increase in liability. Debit. No, it is credit. Increase in asset, decrease in liability. It is debit, not credit. It is given credit. Only expenses, losses are debit. It is correct. Dash occurs if a transaction is not recorded, whereas dash occurs when one error is set up against another error. Not completely, there are errors, various types of error. One is error of commission, that we will discuss in detail. Then error of omission. Commission means partially left. Omission. Then compensating error. One error is compensated by another error. Then another is error of principal. If the transaction not yet, error of principal. Treating the capital expenditure as a revenue expenditure and vice versa is the error of principal. Partially omitting one transaction to the postage in the ledger is error of commission. If completely a transaction is omitted, it is error of omission. If one error is compensated another error, suppose instead of debiting one account for 1 lakh, we have credited. Simultaneously, instead of crediting another account, we have debited. So this is known as compensating error. This is compensating error. One error is compensated by another error. Journal is books of original. The process of recording transaction journal is journalizing. Which of the following is a credit balance done? That is, sold goods to Rama is a credit transaction. Sold goods, nothing given. It may be credit transaction, it may be cash transaction, nothing is given. So it cannot be assumed that it is credit transaction. Sold goods for cash, it is not credit transaction, cash transaction. Sold goods to Rama for cash, it is cash transaction. Only when it is written sold goods to Rama, nothing is given for cash, means it is on credit. An account is a summary of dash at one place relating to a particular head. All transactions relating to a particular head, suppose Ram's account, all transactions relating to Ram will be recorded in the Ram's account. So that is ledger. This is account. In how many types of account can classify? 3. Personal, real, nominal. If credit side is more than the debit side, the balance is, this is credit side is more than the debit side, it is credit balance. The difference will put in the debit side. To balance carried down. Then the trial balance means there are no error, no fraud, no casting error, no omission error. Answer is no casting error totally. Taking at the time of taking the amount, totaling the amount, balancing the amount, that is there is no error. It is known as no casting error. It is known as casting error. Ledger folio. LF stands for ledger folio. X sold goods of 10,000 on trade discount. So X sold goods of 10,000. You see here sales price 10,000. That is known as mark price, not sales price. This is mark price or invoice price. Suppose 100. Here it is given X sold goods of 10,000. Trade discount 10%. Here 10,000. Less trade discount is directly deducted from the invoice. So for that no journal is prepared. So it is 10%, 1,000. So then cash discount is given in order to generally the supplier of goods gives the cash discount in order to make the prompt receipt from his customer. So here cash discount is suppose 10%. Cash discount is 10% of 9,900. So cash discount is given only 5%. So 5% is 9,000, 5% 450. So 450. So sales price is 8550. It is given 8550 is the correct answer. Following account has a credit balance. Carriage inward, no. It is carriage inward, carriage on purchase. It is expenses, direct expenses, debit balance. Carriage out means carriage on sale. It is also indirect expense. It is debit balance. Return inward means sales return. It is debit balance. Then only return outward means return outward purchase return. Purchase is debit balance. Purchase return is deducted from that. So it is credit balance. Patent register is real account. I already told you land, goodwill, patents, copyright, trademarks are also real account or intangible asset. Purchase book kept to record or credit purchase of goods. A return inward book is kept to record return of goods sold. Total of sales is posted periodically to credit of sales account. Sales book is kept to record all credit sale of goods. Sales return book to record return of goods sold. Which of the following not a source document? Source document. It is given cash memo. Yes, it is source document. Invoice, bill, paying slip, all are source document. Cash book is not source document. It is a subsidiary book. Which of the following should you use to record purchase of furniture on credit? I already told you journal proper. Purchase of furniture on credit. Purchase of goods on credit, correct. It is in purchase book. Purchase of furniture on credit, it is recorded in journal proper. Recorded in journal proper. Which of the following account is increased by debit entries? Here machinery. Machinery purchase in machinery account debited. Credit balance in bank account is known as liability. Debit balance in bank account is asset. Credit balance in bank account is liability. That is overdraft. Is a liability. Return outward goods makes a record of goods returned to supplier. Thank you for watching this video. This video is very important for the not only the bankers who are appearing the Jaiib and Dbf, but also to all commerce stream students and the banker who are attending their day-to-day activity or service, and also those who are preparing for promotion test. So don't forget to like this video, subscribe this video if not subscribed. Then share the video to as many number of friends so that everybody will be benefited and it will create one motivation to prepare more and more video for all of you.